This podcast is brought to you by the Wharton School at the University of Pennsylvania. For those investors who wonder what their financial planners are earning off their investments, there's been a website that has provided information as to just how much. But now that website, letsmakeaplan.org, is no longer going to disclose that information. The site was run by the Certified Financial Planner Board of Standards Incorporated. Tom Meyer is the CEO of Meyer Capital Group, located near Philadelphia, and he joins us here in studio to dig into this story. Tom, great to see you again.
Dan, great to be here.
This information is very important to a lot of people, and it's become very much a hot-button topic in the last couple of years. So not having this information means what, do you think?
All right, well, let's think about this. It's probably never been a better time ever for individual investors. Transparency, low-cost investing, easy investing, except one thing. The cost of investment advice hasn't changed at all, and now becomes even more convoluted. So when you have websites that actually try and bucketize what each advisor gets paid or how they get paid, that really helped the individual investor make a decision.
Yeah.
Well, guess what? Now all of a sudden, you got three choices. You got a fee-only advisor, a fee-based advisor, or a commissioned advisor. That's your three choices today. So now, without some type of help from that website, they now have to go just pick a financial planner and say, hey, it's up to me to find out what you get paid. And it's so convoluted. The industry just keeps making it harder and harder and more difficult for people to understand how much of their hard-earned money is going to pay fees.
And it sounds like the CFP actually wants those conversations to occur. They would prefer put it on the investor, you go talk to the person, than us providing the information.
Yeah, but that's where people get taken advantage of. And that's a problem because a lot of individual investors don't ask that question.
Right.
It's very simple. When you go to buy a car, you go out for a meal, you always say, how much is this and how much is that? What's the blue light special? Whatever. You know where your hard-earned money is going. Not when it comes to investment advice. It just blows my mind.
I guess to a degree, is it like the old concerns that probably you and I have both seen and our parents taught us about talking about your pay? I mean, there's an uneasiness about talking about your pay, and I'm wondering if it's similar here.
It is. It's almost like sometimes they get embarrassed to even ask, how much am I paying or how much am I paying for this service? But come on, this is your hard-earned money. And in today's world, what I've seen cross my desk in the past 38 years will just blow your mind of what people think they're getting for free. I mean, you want to go there? I mean, I didn't pay anything for this bond, or I didn't pay anything for this annuity. And I say to them, do you think you went in on free bond day or free annuity day? I mean, come on, they got to fill their car up with gas and feed their family too.
We're joined by Tom Meyer, who's the CEO of Meyer Capital Group, joining us here in studio. We've talked a lot about the relationship between the investor and the investment advisor, and especially in this day and age of robo-advising. How important then does it change that dynamic in having that conversation with your investment advisor?
It does, but just remember, Robbie the robot isn't calling you when the market goes down 1,000 points. And when you want to have that hand-holding moment, when you want to have advice spoken to you, yes, Robbie the robot is cheap. There's no doubt about it. And there is a place for that in investors' portfolios, especially the millennials. I mean, they really enjoy that type of investing. And it's cheap. There's no doubt about it. I mean, that is probably the cheapest product out there for an investor to start investing if they don't want the advice, the financial planning, and so forth and so on.
So what do you expect then we'll see? I mean, could we potentially see this website at some point go back to providing this information, or is it done?
No,
set
it's
and
done.
Over?
So I think, there's a plethora of opportunities for individual investors to go onto the web. If you go to napfa.org, they are a website that is fee-only. Financial planners, investment advisors, CFPs across the board, 100% fee only. So you know what you're getting when you go to that particular website.
Right.
That still doesn't say that you shouldn't ask that tough question is, hey, how much am I paying for the advice, A, and B, how much am I paying for these products?
Yeah.
That, there's internal costs that kill the overall total return over a period of time.
The Wall Street Journal a few years ago, and I guess this is part of that transparency that you've seen develop. It used to be where, according to the report in the Wall Street Journal, you would have investment advisors who were saying they were one thing on this website, on this Let's Make a Plan website, and realistically, they were another thing as well.
Well, look, let's go all the way back to the 80s when it was clearly defined. If you were a RIA, you were a fiduciary, a registered investment advisor.
Yeah.
Okay, mostly fee only. If you were a stockbroker, you were a stockbroker.
Yeah.
It was simple and easy. Then the early 90s came, and all of a sudden, everything came convoluted, and the advisors were everywhere.
Yeah.
Stockbrokers are no longer called stockbrokers. You remember that.
Yeah.
Okay,
Yeah.
now they're investment advisors. Insurance people were now investment advisors. The butcher down the street is an investment advisor. I mean, it's just getting out of control, right? And now they're taking the word fiduciary and throwing that against the wall, because now all of a sudden everyone's a fiduciary. However, are you a full-time fiduciary?
Yeah.
Are you 100% fiduciary 100% of the time? And now unfortunately, that's convoluted for the individual investor also.
All right, I would be remiss if I didn't take a couple minutes of your time and talk about what we've seen on Wall Street the last couple of weeks. And
what are you talking about?
Yeah, really. So the Dow's down almost 1,000 points today. It's obviously been a roller coaster ride the last 2 weeks, mostly heading down the slope.
Yeah.
What are you telling investors right now?
So, here's a scenario where volatility, I love where, the talking heads talk about volatility. Oh my God, the volatility on the downside. Well, guess what? We've had volatility on the upside for the past 12 months up until the end of February, right?
Yeah.
So it works both ways. But this is a wake-up call to individual investors. This is what we call black swan event, a big tail coming around and just slapping that portfolio down. But this also begs to the question of, are you in the right asset allocation? We got a little bit greedy, we got a little bit complacent, and all of a sudden this is a wake-up call for individual investors and saying, hey, maybe I'm a little bit too aggressive. Yeah. Unfortunately, you buy umbrellas on a sunny day, right? but it's never too late to maybe start to, reallocate, as long as you're not losing sleep. That trumps everything. This too will pass. We know that.
Yeah.
It's beyond a reasonable doubt that it's going to pass, and we could have that incredible V recovery. And the only way you're going to be and hit the bottom is to be in it.
Yeah, and the expectation is, I think, of a lot of people, whether or not it's the second half of this year or early 2021, you're going to see that bounce back.
That's right. And don't forget, the market is an efficient machine. The market right now is recalibrating for at least 1 to 2 quarters. 2 quarters of negative to zero growth.
Right.
That's what the stock market does. So it's recalibrating price-wise, and it happens quickly. Right now, the algo boys are going crazy here with the computers. So sometimes it pays to just take a step back. However, if you have cash needs, my goodness, you shouldn't be involved in this to begin with those cash needs, but you have to realize that this could go on a little bit. So make sure that your cash needs are bucketized for at least a year or two.
Expecting to see the Fed make another move?
Why? I have no idea. Yeah, I guess so. It means nothing. We need fiscal stimulus right now.
Okay.
Not monetary.
What about policy, though?
Oh, well, that would help, wouldn't it?
Well, right.
I think you've got to support and backstop the small, mid-sized businesses for their employees that want to stay home. They're afraid to stay home because they have to put bread on the table.
Yeah.
You have to do some type of tax credit, anything to backstop them to pay their employees to stay home.
Yeah. I think the other question is how this is all going to play out, at least in the short term. When you think about things like the jobs report and some of the other economic data, the numbers have been great. But Jeremy Siegel came on this show the other day and he said, you know what? No matter what happens the next couple of months, we're starting from a great spot.
You just said it. Thank God that this economy was from a position of strength. And accelerating, by the way. I mean, based upon the last jobs numbers you just said. So this helps us more than any other economy around the world that we came from this position. Now it's just a matter of, it's a waiting game. But we will get that V recovery. There's going to be pent-up demand like we haven't seen in a long time. And real quick, I think it's, the analogy is almost like after 9/11. There's 3 or 4 months where we kind of cocooned.
Sure, yeah.
That's what we're going through right now, except on a global scale.
Is this kind of the pullback that a lot of people have been talking about?
Yeah, but you know what?
Because it's a little bit different than a quote-unquote recession because of the coronavirus element to it.
This is not a systemic situation here. This is not a financial situation yet. This is basically a health scenario. But people, it's amazing how short our attention spans are. We went through this the fourth quarter of 2018. We were peak to trough down 20% going into Christmas Eve 2018, and that was a lousy Christmas, let me tell you.
Yeah.
But we just went through this 14 months ago. And just remember, every 12 to 18 months, we have 110+% correction. Every 12 to 18 months. So
Short-term memory, right? This is
part of the market. This is part of the deal. And again, reevaluate your asset allocation is very important.
Short-term memories. Tom,
short-term memories.
Great to see you. Thanks for coming in.
Thanks.
Tom Meyer, CEO of Meyer Capital Group, joining us here in studio. To keep engaged with Wharton Business Daily and other Wharton School shows, visit businessradio.wharton.upenn.edu.